What if you could get almost stock-like gains for a fraction of the cost and with less risk? Well, today I'm going to show you how deep in the money call options can do exactly that. Deep in the money calls cost more upfront and have lower returns on a percentage basis compared to out of the money calls. Many traders overlook them. But with a higher delta and more stock-like behavior, buying deep in the money calls can be a powerful way to capture upside while reducing the effects of time decay, making them a smart choice if you're confident in a stock's future direction. And stick with me till the end, because I'm going to share you this one simple tool that helps me find the best trades. So what are deep in the money or deep ITM calls anyway? Well, call options are contracts that give the buyer the right but not the obligation to buy an underlying asset at a predetermined strike price on or before the expiration date. If the underlying asset's price moves above your break-even price, which will be above your strike, the trade becomes profitable. Now, options premiums are made up of two parts: intrinsic and extrinsic value. Intrinsic value, as the name suggests, is how much the option is actually worth. For example, a $90 strike call on a stock trading at $100 has $10 in intrinsic value. But if you look at a live options chain, $90 strike calls for underlying assets trading at $100 are often more expensive than $10. And that's because of extrinsic value. That's the part of the premium that accounts for time until expiration, implied volatility, and demand. An out-of-the-money or OTM call has a strike price that's higher than the current trading price. That means it has no intrinsic value, it's just 100% extrinsic. In the money or ITM calls are ones with strike prices below the underlying asset's current market trading price. So their premium consists of both intrinsic and extrinsic value. Deep in the money calls are those with significantly lower strike prices, typically about 20% or more below the stock's trading price. So now you know, intrinsic is the real value and extrinsic is basically time and hype baked in. And this will be important in a minute. If you aren't already there, let's visit barchart.com and visit any underlying asset. I've had my eye, for example, on Supermicro for the last couple of weeks, as I think it might be finally ready to break through its resistant level of around $63 to $65. Of course, these numbers are at the time of recording. It doesn't matter what they are today, it's just an example. So I'll enter in the company name right here and click on the result. Today, SMCI is trading at $60.71. Now, let's explore call options on Supermicro. Let's go to the left right here under Options and click on Long Call/Put. Here's why I'm showing you this. You'll see exactly how to compare a deep in-the-money call to a deep out-of-the-money call, and why the price tag isn't really the whole story. Now, just for this example, I'll change the expiration date here on the dropdown to October 17th, which is 79 days away from the time of recording. Of course, you can set your days to expiration to anything you like. Generally speaking, with deep in the money calls, the longer the better, because over time, stocks tend to rise in value. And there we have it, a list of suggested long call trades on Supermicro. On the third column from the left, we'll see the moneyness value, or how much in or out of the money the trade is. Let's compare a deep in the money and deep out of the money call right here. The $45 strike and $75 strike trades right here, both roughly $15 and over 20% away from the stock's current trading price. The deep in the money call is 26% in the money and costs $18.10 per share. The deep out of the money call is 24% out of the money and costs $4 per share. Which one would you pick right now? Many traders would pick the cheaper one, but let's look closer. You may have read about some traders' incredible gains with long calls, often preferring out-of-the-money calls over in-the-money calls. And that's because, on average, out-of-the-money calls have higher percentage returns because you're paying less at the start. But out-of-the-money calls are like a lottery ticket, exciting but often just a gamble. On the other hand, The returns on in-the-money calls are far more realistic. Sure, they're more expensive and feel boring due to the built-in intrinsic value, but that's what the boring part gives you: stability. Think of it like this. OTM calls are like buying a lottery ticket, and ITM calls are like buying a home. One has real value, and the other, not so much. The smart money often uses in-the-money leaps calls to simulate a long position, benefiting from the underlying's upside for far less money than owning the underlying outright. Let me give you an example. Say I'm looking to buy 100 shares of Supermicro. Instead of buying the shares, I could buy one deep in-the-money call for much less than the cost of owning the shares. Deep in-the-money calls work best for high-conviction trades on high-quality, highly liquid stocks where you want reduced risk without sacrificing directional potential. First, deep in-the-money calls have high delta. Delta is the options Greek that measures how much an options price changes per $1 change in the underlying asset's price. Long calls have positive delta because as the stock moves up, so does the premium. So if your in-the-money call has a 50 delta, the premium is expected to go up by 50 cents for every $1 increase in the underlying stock, all things being equal. Deep in-the-money calls have a higher delta. In my Supermicro example, the $45 strike call has an 85 delta. That means, all things being equal, your premium will increase by 85 cents for every $1 increase in Supermicro stock. Essentially, you have an almost stock-like exposure to SMCI's price movement with the leverage offered by call options. And that's why deep in-the-money calls can feel like owning the stock, but with more bang for your buck. Options are also more capital efficient than buying stocks outright. You see, each option contract represents 100 shares of an underlying stock, and they cost significantly less to own as well. If you were to buy 100 shares of SMCI today, you need to fork over $6,071. But with the $45 strike call, you'd pay $1,810. Well, the premium is $18, and since an option is for 100 shares, it's $18.10 times 100. And if you picked a higher delta, your options value increases nearly as much as the stock, so it's a win-win situation. And if that's not enough, you also get downside protection as well. With long calls, the maximum loss is the premium paid to enter the position in the first place. So even if SMCI goes down to zero at expiration, you'll only lose $1,810, and compare that to owning the shares outright, which means your loss could be much bigger. The next advantage of owning deep in the money calls is that they have less theta decay. Theta is an options Greek that tracks how much extrinsic value an option loses as it gets closer to expiration. Since deep in the money calls have less extrinsic value than out of the money calls, you're less exposed to theta or time decay. The reduced exposure to theta means that deep in the money calls hold their value more consistently over time, especially if the stock price remains stable or trends upward. And this makes them ideal for longer-term bullish strategies such as leaps, where you want to get meaningful exposure to a stock's movement for, let's say, a year or more without consistently battling time decay. Bottom line, you're paying for reliability rather than speculation. All right, so using Supermicro again, let's look for leaps trades by just changing the expiration date in the dropdown. As you can see, available expiration dates go as far as the last trading day of 2027. For now, we can pick a date about a year out, say September 18, 2026, which is 415 days away from the time of recording. Then, I'll look at the same $45 strike price. According to the screener, you can buy a $45 strike call on SMCI for $26.10 per share, or $2,610 total. The trade is 25.88%, or $15.71 in the money, and has a delta of 80, and your break-even price is $71.10. To calculate the break-even price on a long call, simply add the premium to your strike price. If Supermicro stock trades above your break-even price at or before expiration, your trade is profitable, so I'd say sooner is better in this case. Now, to get more information about this trade, you can click on the chart icon between the strike price and the expiration date. This will pull up BarChart's new profit and loss charting tool. The first tab here is Profit and Loss, which outlines the details of your trade, as well as charts the potential results. You can hover your mouse over here to see the exact profit or loss points for every price point at expiration. You can also see the open interest for the trade, which is the total number of outstanding contracts currently held in the market and tells you if the options trade has high liquidity. More on that later. The next tab is the Greeks, where you can see delta, theta, as well as gamma, vega, and rho. Theta is minus 1.78, so your long call will lose around 1.8 cents per day in extrinsic value, all things being equal. As the stock rises, theta will also decline. Next is the expected move tab, where it graphs the expected trading range of the stock based on 85% of at-the-money straddle premiums. The range indicates $31 to $90.42. You can also see earnings details, as well as how much the stock has moved on average after its last 4 earnings results. Next is the volatility tab, and this is where it gets a little interesting. As you can see, implied volatility is at 80.99%, which may look high at first glance, but according to IV Rank, which compares implied and historical volatility, it's actually a little on the low side. And that's because SMCI has had heightened volatility in the last 52 weeks, with the highest value clocking in at 219%. This shows why it's critical to check IV Rank, not just the raw volatility number, because it can change the whole picture. The last tab is Trend, a favorite among technical traders. The arrows show the expected direction of the stock based on its 20, 50, and 100-day moving averages. As you can see, SMCI is expected to trade bullishly, which is great news for you. You can also see ATR, or average true range value, which tracks how much the stock has moved on average for the last 20 days. According to ATR, SMCI has moved by $2.73 per day on average. There's also RSI, or the Relative Strength Index, which takes a stock's price movement from the previous 20 days and plots it on a 1 to 100 scale to see if it's overbought or oversold. Currently, RSI is at 68.55%, which means it's nearing overbought territory at the 70% level. Deep in the money calls aren't set it and forget it trades. No. Even with longer dated contracts, you don't want to get caught underwater when the market turns against you. Think of this section as your playbook for staying in control. So here's some tips on how to potentially manage your trade. When trading leaps calls, you don't actually need to hold the position until expiration. If the stock moves in your favor and the premium rises, and you're happy with it, well, no one's going to fault you for selling to close the option. Locking in the profits early can be a great way to take some chips off the table or remove some risk. Now, if the stock moves against you and you want to adjust your trade, you can do so by selling your current position and then buying to open a new one with a longer expiration date, a different strike price, or both. And this is what rolling your position is. And just to be clear, it should only be done if you believe the stock is still going to go up. Rolling isn't a magic fix, though. It's a way to give your trade more time to work if your conviction hasn't changed. So manage your trades like you'd manage a business. Keep what's working, adjust what's not, and always know why you're making the move. Now, buying deep in the money calls isn't perfect, so let's discuss the risks that you face when trading them. First, of course, is the upfront cost. Deep in the money calls may be cheaper than out of the money calls in terms of extrinsic value, but at the end of the day, it's still more expensive to get into the trade. If you have a smaller account and you can't afford the premium, you wouldn't be able to buy the 100 shares anyway, or maybe you could on margin, but not 100% with cash. The next risk is time decay. Like death and taxes, time decay is inevitable, and it will accelerate as expiration draws near. And if the stock doesn't move in your favor, well, that time decay can chip away at your premium. The next problem you may face is illiquidity. The options market works similarly to the stock market. There must be someone on the other side willing to buy your contract from you at the desired price. With deep in the money calls, especially on less popular stocks or far dated expirations, there may be fewer traders interested in those strikes. Wider bid ask spreads make it unlikely that you sell the option at your desired price, which can lead to something called slippage, or the difference between the price that you expect and the actual price that you sell it for. To avoid slippage, use a limit order or aim to trade popular, highly liquid assets like Supermicro. You can see the open interest on any options trade in the options screener section, and of course the profit and loss chart. And here's a pro tip. Treat liquidity like insurance. You hope you never need it urgently, but you'll be very glad it's there when it matters. Deep in the money calls are ideal for traders seeking stock-like exposure with less downside risk and reduced time decay, particularly for those options that have longer days to expiration. Sure, they're not as flashy and they won't give you lottery-like returns, but they do offer excellent advantages that more speculative positions just can't match. So if you're looking to trade with more control and consistency, deep in the money calls deserve a spot in your playbook. Just remember, always look out for liquidity, make sure the trade fits your overall plan, and monitor your positions when they're open. So before trying to buy a deep in the money call, use your broker's paper trading account. See if deep in the money setups work for you, monitor the underlying's movement, and how it affects the Greeks and other metrics. And when you're good and ready, that's when it's time to try it in the open market. Well, that's it for me today. Let me know in the comments below what you think about buying deep in the money calls. And while you're there, leave a like and subscribe to the channel for more. Thank you so much for watching, and I'll see you next time.